Welcome back to Two Gents, Two Cents, brought to you by 15 Minutes of Finance. This episode is all about reviewing our year's stock picks. For those of you who are subscribed to the newsletter, you've seen a lot of these. We usually highlight one company that we're watching for that month, and then we try to hold ourselves accountable and kind of review how those choices did. Obviously, none of these choices are specific stock information or investment advice for any one particular person, but they're just stocks that we kind of have our eye on as a firm. They're ones that we recommend learning more about, and for clients that we did put into these stocks, we kind of review how the performance did and try to go over why did our investment philosophy kind of inform us to choose these stocks, which ones did well, which ones did bad, and what's the reason for that. So it kind of gives you guys an inside look into an investor's choices and thought process when they're making investment decisions. Obviously, the thought process we use to kind of analyze how did this year do, that same thinking goes into next year as we start to think about for new clients or clients who maybe are shifting their philosophy a little bit, maybe their risk tolerance changed, maybe their timelines changed. We look to see what are mistakes, so to speak, that we made in terms of choosing stocks, and then we use that to inform our decisions going into the next year. So, James, this will be a lot of questions to you to answer. And so we have in front of us a lot of the specific choices that you made and the specific ones that you kind of highlighted in our newsletter that you chose throughout the year as kind of stocks that are interesting to watch, that could be dynamic and could shift a lot. We'll talk a couple specifics, but mostly kind of want to go over the market as a whole, and then our portfolios that we've managed. Why did they do well? What were some areas where they didn't do well? And what's your thinking going in? So first, let's just talk about the market overall. So how did the market do this year if someone has no individual stock picks, they're just in the S&P? How did the year look for investors, 2024?
Very, very good. If they were in the market just for this year, just the S&P, like VOO, like some sort of market index, they did great, about 24%.
Okay.
Average is about 10. It depends upon who you ask, but between 9 and 11 is typically the standard rate of return for the market. So 2.5 times is pretty darn good.
And that's the second good year. If I'm remembering right off the top of my head, last year was about 26% S&P 500. I want to say somewhere around there.
Maybe I'd have to. Well, it is for 2 years about 50%. So maybe you're
so 26
right
and 24.
there.
Yeah. Okay.
Yeah. And what's funny about last year is that was basically like the last 3 months. It was pretty much negative or flat, and then the last 3 months, boy, it just took off, which is very unusual for the stock market. Usually the first half of the year is better. Second half, especially November, December, you see capital gain sales, to balance out your gains.
Right.
Market's done great. It's hard to look, unless you are an excellent stock picker. This is one of those years where it's like, look, what are you paying someone for? You could have just sat in the market.
Sure. Yeah, you there's not a lot of losers this year. If your investment portfolio did really poorly, this is one of those years where you need to look at who you're working with and just make sure you understand why things are happening. If you're down or you're up 4%, you're either in an insanely conservative portfolio, or there's some probably bad picks being made when the market is up that much. If you're up 22% or 18% and the market's 24%, that could be very expected based on your risk tolerance, but it's definitely one of those years where you need to look. If you're not performing decently well in the market, there might be some weird choices being made in your portfolio. Is that fair to say?
Yeah, this is one of those years where I would say, and it's tough because it depends. A lot of things are particular to your situation, but if your portfolio did less than 10%, I would have a serious conversation with your advisor. Just be like, hey, I'm just curious, like, what is the reasoning why I'm missing, 150% of the market gain this year? Like, what? And did you take a fee?
Yeah.
So those are really important questions to ask, I would say. 10% is standard. Now, if you're 85, which we don't have for my metrics, we don't have a single 85-year-old listening to the podcast. But if you're up there, you're not going to get 24%, right? Your just risk is significantly higher. So your risk tolerance is significantly lower. So that's going to be like one of the deciding factors. But 10% would be the standard.
Yeah, great. That's good to have a benchmark. So we're going to talk all about kind of investment philosophy and the reason we're doing this now is it's a good chance to look in review. It's before the holidays, and also December is a traditionally pretty stagnant month for the market. There's not a lot of activities until then. So there's earning reports for a lot of companies that have come out. There are some big companies James just talked about in his last episode of 15 Minutes of Finance, where he goes over market news. NVIDIA, I believe, is about a week out from releasing their earnings report.
No, they released today.
Oh, they released today because that was last Friday. That makes perfect sense. Yep. So there is some big news about to have an impact, but in general, a lot of companies have released those third quarter earnings reports. December is traditionally pretty stagnant, and then in January, as companies close up the year and you start to get wind of companies getting ready to release new earnings reports for the full year, then more activity starts to happen. So that's kind of why we're looking at it now before the holidays. So we'll talk all about investment philosophy, but I want to just kind of talk about, what do you believe is the primary onus or reason that the market has done well traditionally, or not traditionally, specifically in this last, let's call it 18 months, that it's done really well? Because if you just look in terms of, I feel like a lot of people, especially following an election, right, they vote often by economic indicators, and it's a huge consideration of what candidate people believe have the best economic ideas. Mm-hmm. But if you look at this last 18 months, it's really interesting that Biden received a lot of blame for inflation and these other bad economic drivers, right? But this last year of his presidency, we saw enormous growth, right? Then there's uncertainty of who's going to win. The market's still doing well. Then it's announced that Trump wins, the aftermarket responds well, that it's good. Right. So I feel like a less informed person would look at it and be like, we've had the at least wind that there's 3 different candidates likely to win, let's call it. And during all of those sort of momentum swings, the market has continued upward for 18 straight months, sort of regardless of the candidate who people believe will kind of push the economy the next 4 years. So is it all just cyclical regardless of president, or have there been economic reforms from both expected presidents that would drive this? Or kind of, as you think about investment philosophies, how do you analyze these last 18 months? What's driving this growth?
Yeah, really, really great question, because there's it's not recency bias, but it's like maybe you would like courtside seat bias. Like,
sure.
You're watching it and you're like, how does LeBron James do that? Like, or you're saying it's like, that's so easy. Like, why can't you stop him? Right. But you're watching, you're not actually playing.
Yeah.
A lot of that has to do, or a lot of that is the same within the market. There's just a lot of courtside bias. And I'm making that term up, by the way. That's not like a legitimate.
You'll hear that 2 years from now. You'll start hearing about courtside bias. We started it. 15 Minutes of Finance.
The truth is market is king. So the market, no matter who's president, is going to do what the market's going to do. And it's because it's just so large. I mean, I don't know how many companies there are in the world, probably 100,000, maybe more, maybe 1 million. I couldn't tell you. But just within the US, there's tens of thousands. So now you have tens of thousands of companies, and they're going to grow regardless of who the president is. Now, obviously, there's certain government contracts and different policies that could affect certain companies, but the market is king. It's too big. And it's not too big to fail, but it's too big to hold it back, or too big to keep it high on a castle made of sand kind of thing, right? So it's going to eventually, everything balances out. There's another basketball term, is it averages out in the end, right?
Yeah,
you may shoot 10 for 10 one game and go 0 for 8 the next 3 games, right?
Speak for yourself.
Yeah. But it just like it will eventually balance out, and that's the case with this market. Is just to use the presidency as an example. Did I like some of Trump's economic policies for American companies a little more than what Biden did? Sure. But I don't think Biden did things to hold back American companies.
Sure.
I just think that what kind of happened is it's like a rubber band. Like, you keep pulling it and pulling it and pulling it, and eventually it's going to snap back with equal force the other direction. And I think that's what happened here. Is, look, the first 2 years of Biden's presidency there was COVID, there's wars being talked about happening, etc. And then once those things level out, it's kind of like, all right, well, that was holding back the market, but now it's going to shoot back.
Yeah.
Because when things normalize, the market really takes over. The market is a buy the news, sell, or buy the rumor, sell the news. So when there's things happening in the world, the market reacts, but then once it normalizes, it always returns.
Yeah, it is an interesting, almost like disturbing thing how quickly the market rebounds. Like the economy does so well. It's like, oh yeah, there's multiple wars across multiple conflicts that are still actively hostile. And, for Walmart, it only matters so much.
All-time
right?
highs, by the way, yesterday, Walmart.
Okay.
So.
All-time highs for Walmart. There you go. Invest in Walmart. That's news for you. No, just kidding. So let's talk about here, quick fun fact, just because I was curious when you said that. So across the entire world, all exchanges, there are 55.2 thousand public companies. So you were pretty spot on.
Well, I
would have said like 8 million. So
really? Oh, okay.
100,000 I thought was pretty, pulling it out of thin air.
55,000.
There's 55,000 total public companies that are listed on an exchange globally.
Oh, okay, yeah. Okay. So yeah.
Total companies, probably tens of millions.
Right, but on an exchange, tradable, public, etc. Wow. So yeah, look, I think the president, that position is the highest position in the world, right? You're the quote unquote world leader, but to hold back 55,000 companies, it's pretty difficult to do.
Yeah. So let's talk about that concept you talk about. It's one of the most important things to understand when you're talking about investing in the market and all that type of stuff is one, adjustment, and then I believe you called it kickback or bend back or whatever. So we're now on a 18-month-ish upward cycle. Mm-hmm. The question would then become, are we set for a bounce back? Are we about to see losses because we're on unsustainable growth, or is there reason to believe that the growth can sustain and this bounce back we're not due for it yet?
Yeah, so this goes into one, anything I talk about or any investment manager, fund manager, swing trader, day trader, everything they talk about, there is no certainty. Everything is just going to be opinions. That's all of it. So it's my opinion that we were in a recession probably till last year, and then we came out of it, right? And I had talked about it in plenty of 15 Minutes of Finances, like, hey, we are in a recession, we're going to get out of one. Whereas there were a lot of people saying a recession's coming. If you use just the technical definition of a recession, it's just repeating quarters with negative GDP, or in a market, you just have negative quarters of negative return. Usually 10% is the standard, but negative return would also, you have bears that would say that's a recession.
Yeah.
And I was one of those in that sense because we did have 2 years of not good return or stagnancy. And economically, we were in a recession with our GDP. So in my head, it was okay, most markets bounce back within 18 to 24 months. We know that, right? We hark on that here in this on this podcast. Well, that was my philosophy. Okay, is this typical to, COVID's different. We've never had a COVID before. Is that going to affect the market? How did the market react when COVID happened? It lasted a month and a half, the quote unquote recession dip, whatever.
Yeah.
So I viewed this like I would any recession. And a lot of people put politics into the purpose or into the reasoning behind different investment philosophies. I do my very best to try to not think about the political nature of things and just think about the market as a whole. What has it been doing and how is it reacting? And I just think we were in a recession and now we're climbing out of it. And so typically bulls after bear season just means recession, they're longer than a year or two, right? Mm-hmm. And that's why I think we're bullish with that. And also companies keep growing, revenue keeps increasing. It is expanding here in America. So that's my reasoning.
Yeah, no, that's great reasoning. I believe long-term sort of trend analysis, if you will, economic cycles are about between 6 and 8 years. We'll see some level of drop and then there's recovery, or so it's technically a recession or drop, and then the trough at the bottom, and then recovery, and then peak, and then recession, and then trough, and then recovery and peak. One full cycle traditionally is usually between 6 and 8 years. Okay. So that would dictate that we're not due for a recession necessarily right now. We're on our way up, as you mentioned, for less than 2 years. So it could go on for another 5 to 8 years. We could be on the shorter side, and it'll happen before the end of Trump's presidency. We don't know.
it's important to note too, a lot of fund managers, I get caught up on that term because it's also just people who are investment managers. I'll use investment managers as a term because it's more broad. But a lot of investment managers think the S&P, it's at almost 6,000 right now. They think the S&P is going to be at 15,000 by 2030. So, I mean, there are people who think this thing's going to darn near triple, and they're investing like it. Not only are they investing like it, but the quote unquote insurance investors, so think annuities, ceiling notes. I don't want to get into too specific about those, but anybody that says they offer you guaranteed downside protection, they're offering some pretty ridiculous products where I'm even looking at them being like, oh, that does sound pretty good.
Right.
Like, oh, we can get 50% S&P capture and no downside. It's like, oh, that sounds pretty good. But the truth is they're offering those because they know that they can go around and invest it and get the difference because they believe it's also going to be a tremendous growth period.
Yeah, if you just follow the money, the fact that so many companies are willing to guarantee you traditionally very high rates of return means that their risk analysis would say that the risk of downside is pretty low. Otherwise, offering that would be ridiculous. Right. So that tells you something about kind of the big players in the game, what their perception is of the next 4 years, that they're willing to offer such guarantee against loss because they don't see loss happening.
Right.
So let's talk a little bit about some of the stocks you've personally highlighted that we've talked about on the show, that you've highlighted in your newsletter. I'm going to list them real quick, and then we'll kind of talk about how do you choose companies and how have some of these done. So
perfect. I love it.
Just going in order from our newsletter, we had NVIDIA was one to watch. Kava was one to watch. March was Qualcomm. My next question is going to be, what the hell is this company? April is Chubb Unlimited.
I almost just put Chubb because I wanted Brandon to be like, what on earth? But Chubb Unlimited, I felt like gave real good emphasis.
I personally know a lot of people talking about Chubb Unlimited around the dinner table. May was Palantir. June was SoundHound. July was Novo Nordisk. August was Costco. There's one everybody knows. Costco, everybody.
The one well-known guy.
And then September was Bitto. Is that how you say that? Bitto. So I know for a fact some of these I'm invested in. Some of them I'm not. So there's some that I have a rough idea of how they've done. What makes you choose a company? So specifically with our newsletter, you choose one each month. You talk about it. You say, look, it might not be right for you, but it is one that we're looking at that could be an interesting investment choice. How do you kind of, obviously as an investment professional, hopefully anyone in your field is doing this, you're trying to stay up on the news. I'm sure you've got all sorts of alerts when big economic things happen. So sometimes that kind of triggers, oh, I should read about that. I should read about that. You take all that information. What does the process look like? Synthesizing that down to, here's one company I should look at rather than here's an industry I should look at, or here's a ETF with 15 companies I should look at. What makes you boil down to one company to focus on for a month?
So first off, this is like my favorite outside of basketball and maybe the Bible. These are my three favorite things, and Pokemon. Let me nerd out with that too. So these are my four favorite things that I like to talk about. In full disclosure, I had to learn this. Like when I first started my career, it was sales and shut up. That was like the industry. It was like, get my coffee, get me clients, shut up. Don't ask any questions. I hated that.
Yeah.
Because the way I learn is I humble myself entirely. If I really like something, I will not be afraid to be the stupidest person in the room. And with this, in my industry, that was punished. You were treated as an outcast. You're asking too many questions. And eventually, through trial and error and trying to be around the best advisors, I've learned that there is no right way to do anything. Somebody will always have an argument against your thought process and your philosophy. There is no correct answer. Okay, that is the first thing I would say. The only wisdom in this industry is hindsight. So looking back. So before we talk about just how we did or how I pick stuff, I would want to let everybody know anybody who invested in these picks, especially as a whole, like I would call this our quote unquote growth portfolio, they did really well. We'll be entirely honest with you. They did really well. They did better than the market. And that might never happen again. I might pick terrible stuff next year.
Right.
And, then I looked good for 1 year and now clients are losing money. All that stuff, my job is to know not only what to buy, when to buy, but when to sell. And that is the biggest issue with most investors is when to sell.
Yeah.
So that still has to come up with a lot of people, or that's an ongoing process with these portfolios. So that's the first important thing. No right answers. And it's pretty easy to pick good companies. It's hard to know when to sell bad companies. That's the philosophy that I try to obtain. So my big deciding factors with a company, first off, is that I need time. So we'll use NVIDIA, for example. I've known about NVIDIA since 2018. And I think my dad, he was the first one who was like, I'm going to put some money in NVIDIA. Well, my dad is very conservative as an investor. And in 2018, I didn't really know what I was doing. So when he was like, let's get NVIDIA, I'm like, yeah, sure. I'm on board. Let's do it. Well, 2 months later, it goes down 10%. He gets scared. He sells. Okay. Shout out, Dad. Sorry if I'm putting you on blast here. Well, look at it now. It's 1,000% since 2018. Let's look at what it's done real quick. It's probably I'm using this as an example of time is the most important thing. So 2000.
While you're looking that up, I can just pepper in a little bit of information here. In January, when we picked NVIDIA as our kind of stock to watch in January, it was $48. It's three figures now. So there's the growth you can see just in the short term.
So
11 months or whatever.
NVIDIA since 2018, and maybe it's 2019 because this is a 5-year graph here, but it's gone up 2,667%.
Okay.
So
it did all right.
And full disclosure too, we bought back in January this year because my dad now trusts me. I've been in this industry a little bit longer than back then. And so I had 4 or 5 years to really get comfortable with NVIDIA and see just their business practices and what it is that they're doing and et cetera, et cetera. So first thing is time. I need time. So all of these companies that you see on here that we had just listed, NVIDIA, Kava, Qualcomm, Chubb Unlimited, et cetera, all of these companies I knew about for at least a month. And I use a month as like a baseline because some of them I knew about them, like Novo Nordisk, but because you just know, like, right, you've heard of Wegovy semaglutide, the weight loss drug?
Yeah.
Right? That's Novo Nordisk. So you know about it, but you don't know it, So that's kind of the thought process. One is time. I need at least a month of hearing about it. I don't care if it goes up 600%. I need time. So first is time. And then second is you need to know the story. And we've talked about the story in the past, but story isn't just like, it's a weight loss drug. Everybody wants to lose weight. It's got to be the story of their CEO was 700 pounds and then they took this drug and now they believe in it so much that they've worked their way up from the bottom of the totem pole to now become the CEO. That's not the story of Novo Nordisk, but
right.
That's what when you hear story, it's got to be compelling. And every single one of these companies has a compelling story. And I won't go into each one because each one of these deserve their own episode. But so time, story, and then third, it has to be the financials. And we've talked about different type of analysis. There's fundamental and technical. I believe in fundamental. When you hear fundamental, just think intrinsic value. Like, what is it worth right now? What's happening right now? Numbers right now, people right now, etc. Whereas technical analysis is like momentum, chart movement. Technical analysis is more short-term and maybe some mid-term, and fundamental is big picture, long-term. So with my fundamental analysis of these companies, I'm looking at what are their financials, right? Like, are they being efficient with their revenue? Because we've talked about earnings per share and different metrics before, but we haven't really talked about what makes a company better than its competition. And to me, that's either you have some sort of like monopoly on something. So if you're a farm, you own all the tractors in the town, you're probably going to do better than the other farms, right? Because you have a monopoly on something. So that's a big factor of it. So competitive advantage. And then also, how efficient are you at building or selling the thing. And every single one of these had some factor that, we'll use Palantir as an example. They have a massive competitive advantage over every software company, every single one. And I heard about Palantir probably in November of last year, so about a year ago, and we didn't invest in them until May. They weren't something I was willing to back up until May. And in November of last year, I don't even know what they were. They might have been $15, $12. And we didn't go in until 18 or 22, I think is what it was. Yeah, 22. And now they're, what are they, $60? Something around there. So those are some of the actual definitive things that I look for. Gross margin ratio is probably my favorite equation, or it's just a ratio. Or
ratio, yeah. Financial ratio.
It's my favorite ratio. And that essentially tells you how efficient are they at using their money. So if you have $1, how well do they use that $1 to sell $10? That would be kind of how I would explain it. And the most efficient companies at that tend to find a way to expand quicker. Just because there's less like things aren't blowing out the window, right? You're able to take you rob a bank and your windows are down, all that money's falling out. They're able to get all the money from the bank to their house.
Yeah.
So I'm ranting, but those are the big things: time, competitive advantage, and where they're at in the market. Story too.
And is that your political opinion that large companies are stealing from the people?
They're reverse Robin Hooding this whole
reverse
thing.
Robin Hood.
Yes,
Nice.
yeah.
They're taking from the poor and
giving it back to the rich, baby.
All right, that's my guy right there. Let me clarify one thing too, just in case there's a misconception about this. When James says I need to know about it for more than a month, by that means it needs to be on the investing radar where we've been closely following it for a minimum of a month. It doesn't mean we found out the company exists a month ago. It means that's the at least minimum time that we're closely following.
Right.
Even after it's gained some momentum. Okay, this is on our radar now for a month. Let's really watch it and decide if this is an actual choice we're going to make for our growth-minded clients or a conservative client or whatever we're choosing this company for.
I'm gonna be like a fat kid in a cake shop or whatever the term is here. I'm excited with talking about these things. The reason I like gross margin is because it allows me to look at companies in an industry, compare them regardless of how big they are. So because it's about efficiency, it's not about size, right? You could be Apple and be horribly inefficient, and it's like, ooh, I don't like that. Or you could be Samsung and you're extremely efficient. It's like, okay, well, they have room to grow. Apple's kind of already done a lot of growing. Maybe you want to go with the most efficient one and not the biggest one in this scenario.
Yeah.
And that takes a month. You have to
at least
have to see the competition, see the market industry, et cetera, et cetera.
Yeah, so let's this is not on our list, but I think it touches a lot of the things we've talked about. So super important to understand when to sell. The story of a company can be very important. Something that I think encapsulates all of this, and we've briefly talked about this in prior episodes, is the decision in some of your clients' accounts for Nike stock. That's a great example of a stock that for some clients you chose, it declined. So you would look at it and say, okay, not a great stock. Now, the interesting factor here is the story of the company, new CEO, like you literally just talked about. It's a guy who started lower up, worked his way up to CEO of the company. So there's an interesting scenario now where you have a company, it's down. Is it time to sell? Or does a company like that, you say, this story is really compelling. I think it will retain its value and we can break even instead of selling now and losing 20% or whatever it is.
Yeah, so Nike it's a sore one for me because everybody knows about Nike, right? That's been around. That's a name brand household company. They have not done well this year or since I put it in a previous growth model that we had. And I have to make a choice. They've done negative 29% this year or something along. It's very almost exactly what the market's grown. Nike's gone down, right? I have to make a decision. Now, do I believe in the long-term fundamental analysis of this company, especially with the new CEO, who legitimately did start as an intern, and then he was mopping floors, and then a manager, and then he was a sales rep. It's like his resume is beautiful. You get to watch it. Just he works his way up. That's a story you can get behind.
Yeah.
So now I have to make a decision. It's like, okay, well, where are they at with their numbers? Okay, well, they are trying to have better shoe deals. Okay. What I mean by that is some of their shoes have gone up 40% in the last 20 years. A basketball shoe, LeBron basketball shoe is $160. Mm-hmm. Whereas 15 years ago, they might have been $100. So now you have to look at, okay, what are they trying to do to make that better? And shoes are obviously just one of the things they do, but it's one of the biggest things they do. So you have to go through that philosophy, or you have to go through that practice of when do you sell this loser, when do you keep this loser. And I've made the decision with Nike in particular, I'm going to keep it for at least another 18 months. Okay. So I'm not even going to look at it in the sense of selling it for probably till 2026. And my thought process behind that is CEO needs time. Okay, his story's great. Their numbers are fine. The biggest issue is the political stuff with Nike, right? Michael Jordan said it best, Republicans buy shoes too. And we have to think about the bigger picture with these companies, right? Bud Light or whoever the other companies are that had this big falling out because they chose to be political. Money is green. That's what you have to remember. It's not red or blue. It's green. And this new CEO, I think, believes that. And that's what I want. I want someone that's not, look, both sides have good people. It's true. Okay. So if money's green, then you should focus on green instead of blue or red. And that's what I think they're going to do.
Yeah.
So.
Yeah, no, that makes sense. So, it's an interesting case study in sort of when those two things collide. Well, it is down. It's not quite showing fundamental analysis reasons to rebound in the immediate future, but the story is good. You can get behind the rebound, and so it puts you in this position where you have to do a lot of research and kind of make that choice of whether it's going to rebound or not, and what to do with that. Looking at the whole kind of composite here of these investment choices, there's obviously a trend here, and I think probably a lot of models would somewhat echo your choices in that with the insane rise of AI, I mean, the first thing when you Google now is the AI response. That's the first thing you see.
Right.
You've got the brand new news of the new iPhone software incorporating AI in its system so that you can give it, I believe, like emails and text messages, and it will summarize them for you or draft like a mock response to a series of text. So iPhone is entering that as a feature. I think they're like the Batman of the tech space, where it's the Batmobile and the Batcopter, and so it's the it's the eye assistant or whatever they call it, but it's just ChatGPT virtually. But they have their own brand of it. So there's obviously going to be a huge influx in tech picks for companies that are growth minded. I think even an outsider to this space who doesn't follow investing, if you were like, what do you think's going to happen in the next 10 years? They're going to be like, I don't know, cars are going to drive themselves, and like we're going to have AI taking over, right? So there's social momentum towards AI. So within that, there's two picks that stand out here. And so where do these picks come from? So you've got, NVIDIA, Qualcomm, you've got Palantir, SoundHound, all of these very tech companies. And then in February, one of our first picks, Cava. They're a healthy, I think Mediterranean-ish bowl. It's like Chipotle for semi-Mediterranean food, right? Very random, seemingly, for someone who's looking at this and be like, oh, this is a tech-minded growth portfolio. But we've got Cava in there. To your defense, it did very well this year as one of your best picks. More than doubled since February. I want to say it's like somewhat, maybe close to tripled or at least doubled, I think, within the last 12 calendar months. So it's done super well. Very successful.
Year to date, it's 241%.
There you go. So more than doubled. Or that's more than tripling, right? Because it's up more than 200%. So where did that pick come from? What put Cava on your radar in the midst of doing largely tech research in the tech space?
Right.
What made them stand out?
Yeah, so full disclosure, I'll be upfront and blunt about it. I went to a Cava. I went to a Cava in Orange County, and I was like, this is pretty good. And we got there, I would say like around maybe like 1:30 p.m., Yeah, it's like after the lunch rush, and then within 20 minutes there was 55 people in line. And then I got my food and I was like, oh, this is actually pretty good. And I wanted to know if they were a public company. And so I just started researching them and looking at them. And I went back in January, January 5th or something. And I just kind of became obsessed with it. And if you look at Chipotle's track record, Chipotle, exact same business style. Like there's a cafeteria line type thing.
Yeah, make your own bowl.
Make your own bowls. People are, hey, I want double meat. And you sort of just go through the line. And Chipotle made that business model extremely, extremely efficient. And I saw that they were copying it with also a health-conscious food. That's a pretty good recipe for success. So I just started looking at their fundamentals and their financials and looking at what they value and what's important to them. And I fell in love with it. Now, all of that to be said, that's a really simple answer. But my favorite fund manager of all time, Peter Lynch, he was One Up on Wall Street is one of his books. If you want to learn about picking stocks as a retail investor, which just means like a typical citizen, you're not an institution or anything. One Up on Wall Street, one of the best books I've ever read, because he talks to you like you're in third grade, which is what you want if you're going to learn a complicated topic.
Yeah.
And I've talked about this a lot, but his big pick that made him famous in the 80s was La Quinta, which is a hotel, famous hotel. It's all over the place now. It's a franchised hotel. He heard about it from a friend who was like, yeah, I'm staying at this La Quinta. And he's like, a La Quinta? What is that? And he started traveling to different La Quintas. There was like 4 or 5 of them or something. And so he went to every single one. And what he found is that La Quinta wasn't a Motel 6 and it wasn't a Marriott Courtyard or a Ritz-Carlton. It was something in the middle. And that's what the hotel industry was lacking, where they were lacking like $100 a night, but still good service, free breakfast for the entrepreneur businessman that's like, I don't want to stay in a spring mattress. I don't want to be worried about cockroaches everywhere, cheap as possible hotel. And then they also don't want to go where they get a temple massage to wake up from a hotel worker. They wanted something in the middle. And so he sort of fell in love with that, again, competitive advantage that they had. And he dumped a bunch of money into it. And by a bunch in the 80s, like $5 million for a fund, mind you. And I think that $5 million became $250 million or something within 18 months.
Wow.
That's what we call a 10-bagger. And I get that term from him. We want something that 10Xs, right? 10X or more. And that takes time, takes investment. You need to experience the product as a investment manager. And I firmly believe that. You have to feel the experience, because that's what's going to decide whether other people purchase it or not.
Yeah.
So I did that. I know it's pretty remedial, like, oh, he went to a kava, but that's how the best things happen that way, right? I didn't see anything special in their fundamentals except for their revenue was growing over the last 2-3 years. That's a big deal. Okay, they're trending in the right direction. Their share was not overpriced. Now they're overvalued because so many people have jumped in, but I don't think overvalued means it's time to sell. If anything, that means that it's probably going to trend upwards even more, in my opinion, because these things are popping up. It's a restaurant. So they're going to pop up all over the place and people are going to start going. And I think it's just going to continue to trend upward. So that was the thought process behind Kava in a technical portfolio. I really liked it. And also, when you're creating portfolios as an investment manager, you have to decide what the theme is. And for me, I just wanted growth. I wanted to say, hey, we actually have started creating portfolios that people are in or they're partially in, and we can point to individual picks that we've made that we really, really like. And that's why a lot of them are tech, mainly because in that space, I think, sure, maybe there's a resettling or even a down market with AI, but in 10 years, AI is going to control the space of most industries. So I would say, I don't want to call you a fool, but I would say you're missing out on obvious trends for growth if you're not paying attention or in the AI space. So that's why, more than half of them or about half of them are AI tech related. But everything in that portfolio is like I have intimate knowledge of, and you need that when you're going to be putting other people's money in the positions. Yeah.
So, and for those of you who don't know, James does do this a lot. He'll sit down at a place, and then before the food comes, he'll go, What do you think their stock's worth? And then you have to guess how much their stock's worth. I'm never close because I don't know how many stocks they have outstanding, so it makes it very hard to answer the question.
Right.
So let's talk about in the portfolio any that did not perform.
Okay.
Are there any, and kind of what you're thinking now, looking back, and maybe it's not a super far back pick of yours, but you started watching it. Maybe some clients are in it, or maybe your own money's in it to test it a little bit. It doesn't perform well. What do you kind of learn from that, and what performance wise didn't align with what you were expecting to happen with that choice?
So a lot of funds are public, and some of them are private. Ours is private, right? To get any of these picks when we made the investment, you had to be a client or you had to be paying for the newsletter, right? That's not public information. You just get what you get if you work with us. A lot of new funds, they just throw stuff in there that other funds have. And what I wanted to do was I wanted to really try to pick unique things to 77, to us. And to do that, I had to try and learn about all different types of industries and markets. And next year, we're going to do the same thing. I'm going to have to invest incredible amounts of time naying and yaying different individual equities. So all 12 next year could be bad, all 15, all 10, all 5, whatever it is that I pick, they could all be bad. Luckily, this year, there's only, maybe we'll say 2. We'll say 2 bad picks. And again, this is when you have a fund or a portfolio, there's themes. It's not like, oh, this one's going to grow 600%, so we're going to pick that one. That doesn't exist because there's too many factors: time, risk tolerance, how much money is going to go into it, right? You can't buy Chipotle if the stock's $10,000. You can only buy one share, right? So you can't buy one share and say, yeah, you're invested in Chipotle with someone who's got $10,000 to allocate, right? So you want to try and pick low-cost, growth-oriented companies for a growth portfolio, which this is, right? We're probably next year I'll create an intermediate portfolio and then a conservative portfolio, and slowly we're going to have these models that we put people in. But right now, growth, which I'm glad I started with growth because it did really well. But there were 2 bad picks. First one I'll talk about is Qualcomm. I think, what was Qualcomm's price when we... Let me look real quick. It was $159. So that was in March. It went up a whole bunch. Okay. It went up, let's see, sorry, to $229 in June. Okay. I looked like a genius in June. Now it's at $154. Okay. I still think Qualcomm's a hold. Right? So did they make any money? No, no one made money if they held, but they got to see the opportunity and the spike there. So Qualcomm has been around forever. It's one of the oldest technological companies, communications companies. They're not too big to fail, but they're too big to not inherently just get in on the AI space. And so now I'm looking at Intel, Qualcomm, Apple, Microsoft, and I'm seeing how in that industry, how interesting or how focused they are and interested in the AI space. AI was the thought process with all these companies. Who wants to be at the forefront? Qualcomm's at the forefront. They like it. So my potential or my return potential thought with this is a 10-bagger. And 10-bagger is a term I stole from Peter Lynch. It's something that 10x's. I think Qualcomm could be $1,500. They'll probably do stock splits and whatnot. But I could see them being $1,500 by 2030. So they're an industry trailblazer, in my opinion. Really, really like that. Did anybody make any money this year? No, because I would have told you to hold. You're not in this for whatever. You're not in this for 60% growth. You're in this for 10 bagging, right?
Yeah.
10 bagging is my thought process with these picks, assuming the story stays the same. So that's the first one that didn't do well in the AI space.
And in fairness, Qualcomm is not just you've been watching Qualcomm for a couple years. We've had conversations years ago about Qualcomm. So it's also not one that you thought now's a good time to get in as they go hard for that AI space. But in general, it's been a company that you've liked for a while. So
Yeah.
it's probably an easier
It was
pull than
easier
a
sell.
brand new AI company.
100%, 100%. And then the next one is Novo Nordisk, which this is, like I've said, anybody you speak to who picks companies for other people's investments. When you invest your own money, your thought process is different. It's just not as good. I can't explain it. It's weird. It's like me with things. Like I don't treat. I'm not the most careful with my own thing. I don't make my bed at my house, but when I stay the night at someone else's house, I make my bed every day. I guess that's how I would think about it with investing. So when you're investing other people's money, you make sure you make the bed. You take care of it, and you need a thought process. You need a standard. So I had to create my own standard, and one of my standards is I like companies that do American things that aren't made in America. So we'll use NIO as an example. Okay, NIO stock was doing really, really well, went up to $60. Now it's like $5. Okay, so NIO is a Chinese car company, electric car company, that they're trying to get in America. But cars is an American thing. Everybody loves cars here. Okay, electric, especially electric. So they're making a better Tesla model. Now, I love Elon Musk, but the cars are just falling apart on the road. The battery's built into the chassis, so it's when the battery goes, the car's got to go. So NIO kind of destroys improves upon all of those bad things that Tesla has. Now, they're a Chinese company. So even though they're doing well, there's a lot of government manipulation and there's discrepancy around Chinese-made things. So that company, even though they do an American thing in cars, especially electric cars, investing in them is a really risky, honestly ballsy decision. And I still like the car company. So the reason they're not on here is because of that. I would say that they're like a bonus pick. But I bring them up because they're what we call an ADR, an American Depository Receipt. So they are a Chinese company that when you buy through any platform, right, Schwab, Robinhood, etc., you don't really get a NIO stock. You get an ADR. So it's like a coupon that owns the stock, and you have to pay a little bit extra for that. It's not much. I think it's like 5 cents a share or something. But bringing them up just because they were one of the bad picks also. But Novo Nordisk is the other one that is an ADR company. So they're in Norway or Sweden, one of those middle or European countries. And they created Wegovy, which Wegovy is the name brand for semaglutide T1 or I can't remember the exact compound number. But they created the magical weight loss drug that all the celebrities have been using for decades. But now, because it's had trial and error, it's now become public. So if you know somebody it's called Wegovy face, they've just lost a bunch of weight and you can sort of see their faces all sucked.
So that's like Ozempic uses that same
Ozempic.
compound?
Sorry, yes. Ozempic
Okay, cool.
is Wegovy and Ozempic are the exact same thing. They're just different distributed. They're distributed under different names. Sorry.
Okay.
So Wegovy came before Ozempic, and now Ozempic is like the famous one. So yes, Ozempic. This is the company that created Ozempic. And if you think about America, what do we do? This comes back to the non-American company doing American things. We like to eat. Okay, we're all overweight. So the thought process with this company was we're all overweight. We want to lose fat fast, right? We want to cheat the system. What super pill can I take? Well, this is that super pill. And I still believe in this company. So can you look at it real quick? What was it when we put money in? Also, I appreciate you guys just letting me rant about stocks. I absolutely love.
So Novo Nordisk, and this is July, I believe, 145.
Okay, 145. So now it's at 105. So year to date, it's done 3%. But when we got in, it was at 145. Okay, obviously that's not good return. That's bad. But again, same thing with Qualcomm. We're not in this for 2, 3, 4, 5 months. This growth fund portfolio that I have, I think, what do we have? Eight picks. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 picks. There will probably never be more than 12 in the fund. And the reason for that is because I want to be able to evenly distribute things. So, meaning like I want to be able to put 10% into everything plus cash. So right now it's easy because it's technically 100%, 10% cash and then 10% into all of these positions. So 10 to 12 will always be my maximum. And with this position, 10% in a weight loss drug in America that everybody's obese in, everybody's got diabetes. Long term, it's a solution for these things that you see a need and then you see a fit. And so with this company, again, they're a foreign company making an American solution, which I really, really like.
So what do you think causes a company like this to not move the direction you expected? So this is one of those things where I think the average person would think the story was totally in line. Who hasn't heard of Ozempic in the last 12 months, right? You see Kelly Clarkson on her talk show down 40, 50 pounds, whatever, right? All these celebrities are losing weight. And, is that Ozempic? Is that an Ozempic face? So it would seem like this company's doing well. What economic factors are causing their stock to go down 30%?
Yeah, so the economic factors are rapid expansion would be the only thing I can think of. Like now they're in China. So like in the last 2 weeks, they're expanding into China. Well, I mean, the Chinese aren't exactly overweight. So it's like, okay, well, a lot of population though, right? Like, so maybe that's a market. The big thing with why I think that their stock price has gone down is that once you make a pharmaceutical drug public, especially because this is a diabetic drug. So you can take this drug even if you don't have diabetes, but its purpose is diabetic. The compound information has to be public. It's not patented like how you would think like an invention idea is. There are rules in the pharmaceutical industry that you have to allow competition, and you have to be able to it's like selling name brand versus generic is kind of how it is. And now the generic drugs are coming out. So I kind of got in at the high with this one because the hype is real, but now there's the generic drug being sold, and you can buy it. You can literally buy semaglutide now. So you would like GetThin.com or MyMD.com. Those are companies that you don't have to see a physician. You just type in your information. They ask you a couple questions, and then you'll chat with a doctor, and they'll say, "We're gonna prescribe you semaglutide," and then you pay $500, no insurance. And then you just get that drug. So there are other avenues to get the generic drug that has cheapened, I guess, the name brand.
Gotcha.
Name brand. So
that's that competitive advantage you've talked about.
That's that competitive advantage that we're talking about. So that's my thought process of why it hasn't done well. But hopefully you guys see the story and you see why I like it.
So, but for you, it's still a hold. So what makes you think this company will overcome long-term performance, this influx of generic competition?
Yeah. So right now the generic compound, semaglutide, TSP1 or something like that, you still need a doctor's prescription.
Okay.
Eventually, it's probably not going to be that way. And it's always the name brand companies that get to do that first. So my hypothesis is that as this expands into China and India and all these other companies, right now I think you have to take it via injection. And Wegovy or Ozempic, they're trying to make the pill form. So all of these smaller companies that are selling semaglutide, they're like, okay, we have this drug, we can sell it for cheaper because it's not name brand, but nobody wants to inject themselves. Everybody just wants to take a magic pill. And so I see them focusing on the pill, whereas the smaller companies are focused on the distribution.
And they're the first ones in. They're one of the largest competitors,
Right.
which means they'll be the first to clear FDA testing. So the first thing you'll see on a shelf is Ozempic and Wegovy before these other generic smaller competitors trying to undercut the market are able to get on the shelves and go through all the testing.
And the big thing in my head is the pill more than the OTC over the counter. It's probably going to take a couple years for something to be OTC like that. But if it's in a pill form first, man, that is, I don't want to inject myself. You know? I just take a pill.
I mean, if you just think about it, like how many guys, if you could just go to CVS and get steroids, how many more guys would take steroids? But it seems very daunting to go to the doctor and get steroid injections. It's a, not that it isn't a serious thing, but it really makes it feel like, oh man, this is like, do I really want to do this? But yeah.
So that's our losers. Everybody else was a winner guy, okay, or a winner guys.
2 for 9's pretty good.
Yeah,
2 for 9 went down, and the others went up by between 35 and 300% across the picks.
Yeah, we didn't average it out just because I don't even know if legally I can be like, our picks did 90%.
Yeah.
I don't think I can.
There's no performance guarantee.
Yeah, but I can tell you, if you looked up the names, you would be like, oh, they picked really good companies. And again, that's not always going to happen. But the thought process is when you guys pay for our newsletter, you're getting my investment philosophy. You're getting our picks. It's not to invest in it. And then when we manage your money, we're not just putting you in these like, this is what I get when I work with them. You get a tailored, custom portfolio directly towards your risk tolerance that we have an ongoing relationship about. So like I had a client last night. Boy, he is gone. I think his portfolio overall has gone up 60%.
Wow.
And we're not even, I think half of it is in our growth portfolio, and then the other half of it is balanced between mutual funds and ETFs. But he started looking at his portfolio every day because it did really well. You can't look at something every single day. It starts to mess with you.
I started doing the same thing. You're like, oh, it's doing really well. And then you're like, is it at this much yet? Is it at this much yet? And then it goes down and you're like, man.
Yeah. So it's very dangerous to do that. It messes with your mind. But he was like, hey, I noticed some of it's in treasuries. Like, should we get out of this treasury? Like market's gone down a little bit. And I'm like, dude, you are 95% aggressive. This money is nice to this guaranteed part of your portfolio is very nice. And I explained it to him and he agreed and, we move on.
Yeah.
But that's what you want from an advisor instead of give us your money. We'll help dictate your annual distributions and then someone else manages your money.
Yeah.
It's like I don't know any advisor, Brandon, and to the listener right now that does what I do. And I'm not saying that to say that I'm better than everybody because I've got a lot of room to grow, but if I went to my last firm that I worked at, very big firm, very, very successful, very good at what they do, and you ask them like, well, why'd you pick Tesla? They'd be like, they'd make something up. They would have an answer for you, but it would be generic, garbled, not real.
Yeah.
So you need someone who knows more than you do. Otherwise, why hire somebody?
Right. Yeah, for sure. All right, everybody. Well, another long one for you, but hopefully this gives you a good idea, kind of.
That is long. Sorry, guys.
Sort of Q&A, sort of informative, but just kind of understanding why do investment managers make certain picks and what kind of factors go into that decision-making process. It also gives you some good data. So we always try to encourage people, interview advisors, review your investments, see how they're performing. So again, this is a great year to look, make sure your performance and your portfolio is in line with the returns in the market. If you're significantly underperforming the market, you need to make sure that that's planned for. If that's a surprise to you, you might need to rethink who you're working with, or at least maybe it's been a while since you've revisited your investment strategy with them and you're still maybe invested more conservative than you planned on and kind of didn't realize how important constantly revisiting is. So hope you learned something. As always, leave a comment on a video, send us a message, whatever you want to do, any topics you want to hear covered, questions on the episode that you would like to hear answered in a future episode. Otherwise, we'll see you next time. And as always, invest early,
invest often.